Welcome to Unconventional. I'm your host, Bill Tessar. Unique stories from entrepreneurs that have failed, picked themselves up, been knocked down, picked themselves up again, traveled roads that few travel. It's about digging into the successes that people have found in real estate, financing, lending, and the like. I've always believed that success isn't defined by a traditional path. It's about pushing boundaries, thinking differently, and overcoming challenges along the way. Today's guest knows all about taking an unconventional approach. His expertise has helped real estate investors across the country optimize their portfolios, strategize their success, and ultimately keep a lot more of their hard-earned money. As a managing partner of Robert Hall and Associates, he manages a client roster with portfolio investments just over $500 million. With 2 decades of experience, Tony Watson holds a federal license as an enrolled agent and tax practitioner. It is my pleasure to welcome Tony Watson, who just may be the king of taxes, honestly. Welcome, Tony.
Thanks for having me, Bill.
I do remember the first time we met. It was kind of like a mild introduction, and we shook hands and we just started talking as like two entrepreneurs would do. And I remember that conversation taking off, and I walked away from that 20 minutes going, I need to spend a little bit more time with this guy. I mean, you were spit-firing tax knowledge at me that actually made a difference to me, not just to make you sound smart, but it was applicable in my day-to-day life. And I go, holy cow. And just around the time you think you know pretty much what the tax game is, and you have a guy like you come into one's life. It was, I do remember it. You don't always remember that first meeting, but with you, Tony, I did. I never forgot it. And, we've worked together for some time now. It's been a blessing for me.
Well, thank you for the kind words. It's when you meet your wife, when you go to church for the first time, and when you meet your accountant, right? Those are the three most important people in your life, I guess.
Yes, and I would say, like, the way we think about it would be accountant, God, or no, accountant, wife, God, no, God, accountant, wife, something like that, right? The triangle.
One of those years.
My wife's not here right now, so she'd be throwing something at me if that was the case. What's got you excited right now?
So much. I mean, on the work side, I'm looking forward to what this year has to bring tax code wise. I think that a lot of things over the last 4 years that I was excited about from a QBI business perspective, depreciation deduction perspective. On the tax code, we're always looking for greater benefits or strategies to apply to our self-employed clients' returns. And so I'm really looking forward to some of the parts of the tax code that were wound down during the Inflation Reduction Act over the last 4 years. I'm excited to see those come back. The Republican tax plan form usually is set in place to benefit business owners because they know at the end of the day that business owners create jobs for the U.S. economy. So I think that this year, and it's always important to plan, obviously, but more important than ever this year for business owners and for our self-employed clients, I think the planning side is really going to take off throughout the next 4 quarters. So I'm really excited about that. And then kind of on the personal side, my son started his second season of T-ball. So I've got his first T-ball game this weekend on Sunday. So I'm pretty excited about that.
And how old is your son?
He's 6 years old.
Yeah. So my grandson's 4. He started his first year of T-ball. And I mean, having raised 2 boys, as you know, that both played baseball through high school and played in college, you are in the best time of your life when it comes to your children and sports and just getting started. It's something else, and congrats on that. So,
Thank you.
Tone, were you a DJ before you got into taxes? Like, what's that all about?
I'm always a little hesitant to share that with people, but I feel like it really was because I'm a public speaker as well as a tax advisor. I feel like people need to understand a little bit about where I come from. I mean, I actually ended up DJing all through college, generating quite a bit of income for myself, helping out with school expenses and buying books and things like that. And there was a little bit of a rush getting up in front of a room of 200, 300 college students, and then leading me into the LA kind of DJ scene a little bit in my younger age. But I think that's what really allows me to get up in front of the public and do what I do, which is teach them about probably one of the most difficult topics to get people excited about, which is the wonderful world of taxation. It's not the sexiest of topics, but if you know how to present it, I think that you can drop some true seeds of knowledge for people and get them excited about creative ways to retain wealth. People think it's tax savings, but it's actually wealth retention at the end of the day, and that's how I like to spin it. So yes, I did DJ for quite some time as a young adult.
Before I jump into the exciting part of tax, because to your point, if somebody just quiets the noise between their ears for a moment and listens to the benefit of understanding it, then I think people get their arms around it, embrace it, and there is enthusiasm around it. I will tell you personally, tax actually excites me, like the tax code, what's changing, what we're losing, where the opportunities are. And so that hasn't always been the case, but I think the more you learn, the more you understand how it applies to your life, your wealth, and in the later years of your life, you will get your arms around it. Before then, who is your favorite band today?
Oh, gosh. Man, I'm a big music lover. So if you're talking about kind of more the house music that I listen to late at night as I'm working till 2 o'clock in the morning, getting in the zone, I'd say Kygo. Kygo's got some pretty smooth kind of house loungy music. I'm a classic rock fan, though. I love it. And everything back to Billy Joel. I'm a big Billy Joel fan. I'm a big AC/DC fan.
Well, they're coming here April 19th. They're coming.
I know. And I'm asking some of the guys in my office if we have a pool season tickets here at the office. So I'm trying to get tickets, but they sell out pretty quickly. You want to go to that one? Yeah, they do, especially for DC. Yeah. Absolutely.
So let's jump into it for a second. Like, you're a DJ, right? And people are jumping up and down for you. How do you go from people showing that enthusiasm in a club and you feeling off those vibes, leaving, going home at night, going like, man, I rocked the house. They dug, the way that I approach this whole thing to, I really can see the transition into tax. Like, how does that jump happen? Like, how does it?
Oh, man. Yeah, it was one of those things where I learned, because I played baseball in high school and college as well. And my college career didn't last very long because I came to the understanding that, I'm 5'7" on a good day, depending on how the rotation of the earth is going. So at 5'7", I had to make a decision, right? Same with the DJ business. I didn't think it was sustainable for what I wanted to achieve in life. But it gave me a lot of personal skills that I was able to carry over to the tax world. And a week after I graduated from Chapman University, I moved to LA. And I moved to Glendale and started working for Bob Hall. And I was incredibly fortunate to have the opportunity to be mentored by Bob Hall himself. And so for the first 4 years of working at the firm, I prepared some of the firm's largest tax returns. It was incredibly eye-opening from an intellect standpoint of what this man knows and how his teaching approach is, because I was not ready for the tough love from Bob Hall, which he calls it, and he's like a second dad to me now. So it's nothing but love at this point. But I just truly feel like the DJ side of things helped me fast track my way to helping Bob Hall's clients and getting them to be comfortable with handing their personal financial documents and their personal world over to me at 20 years old, 20, 21, 22 years old. And I'll never forget that experience or that opportunity that Bob Hall gave me, 20 years ago.
So we touched upon it a second ago about the exciting part of tax. And I think what most people don't understand, or maybe they understand the half part of it, is I got to go out in the world. I got to carve out my niche, and I got to go make a buck. And when I make a buck, some of that's going to go to the state, some of that's going to go to the feds, and then what's left, I got overhead, and hopefully, I could zock some money away for a rainy day or for a vacation or a new car or the like. And I think what people miss is that there's volumes of tax code, and we'll get into that in a second. And that tax code is designed and allowable for people to write certain things off, to structure their life in a legal and compliant way where that taxable income is reduced, meaning they're paying less and saving more. And I think once somebody gets their arms around that, all of a sudden, the tax part of your life is almost as important as the earning part of your life. And was there a moment in time for you where you go, I get it now. Like, I am a huge value add in the wealth creation of my clients, not a filer of paperwork and a deliverer of bad news in terms of what they owe the government.
I mean, sure. So in the first 4 years that I worked here, when I was starting Bob Hall's files, he would then close them out. So I didn't really feel that in the first 4 years. I felt like I was helping people, but once I was able to pull in my own clientele, advise them from start to finish, close out the file, get the tax return in their hands, and see the sigh of relief, so to speak, for this business owner to come in and have set aside a certain dollar amount to pay for taxes, and then realizing after all of the strategies and implementation of code on the return that it was pennies compared to what they had set aside. That was incredibly addicting for me early on in my career. And if we do the proper planning, people truly should feel excited about. Because I agree with you. It's just as important as you out making money, because when you make all that money and when you work so hard to achieve certain levels of income, don't you want to keep as much of it as possible? Like, it always blows my mind that I'll strategize with some clients. I'll send them out of my office. I'll give them pecking orders, and I'll give them dates that things are due and what they need to do on their end to get or achieve this bottom line goal. And then they'll come in the following season and say, well, I never actually ended up doing it. And you're thinking, okay, well, the results aren't going to be what we expected them to be. And I use this phrase all the time in my own seminars and my webinars: failing to plan is ultimately planning to fail. And so I really focus a lot of my time and attention on the planning side of tax preparation. And then when people meet with me during tax season, we've already done the plan. So we already know what the tax return is going to look like. That truly is the power of planning. And I've never understood how some people can't get excited, or maybe they don't want to get excited because of too much hatred or disdain for the IRS. But it is an incredibly powerful tool for you to have not only a team behind you on the lending space, on the tax space, on the wealth management space, but if you build that team around you, then all of that hard work and the 15, 16, 17-hour days building and grinding for making your business grow, you won't feel like it was for nothing, right? And that's all about proper wealth retention and strategizing, in my opinion.
Yeah. I mean, I think oversimplifying it, if you look at it this way, for every dollar you can legally and compliantly write off on your tax return, for the upper wage earners with state and fed, I'll just assume California, you're in 45 to 50% tax rate. So just for simple math, it's 50 cents of every dollar. And if you show me how to save $1,000, that's $500 in my pocket. If it's 10,000, 5,000. If it's 100,000, it's 50,000. It's like material. It's retirement. It's real estate holdings. It's all of that stuff. And for me, it's like, I think once I got my arms around the complexities and opportunity associated with that, it changed my approach from day one, and really the way that I spend my money, that I invest my money, that I approach the world. Like tax is such a big part of all of our lives. To not invest time, energy, and resources into understanding how it applies to you and your income and your status, I think is, I think it's a big miss. I think it's as big a miss as not having, regular visits to the doctor. And you talk about planning. I know from personal experience and working with you, do you have regular checkups with your clients?
Very much so. We really push our clients, especially during tax season, when we dial in that bottom line. I usually pitch it to my clients, hey, we achieved this goal, this bottom line goal, because we had put a plan in place, right? So let's get you set up with mid-year planning appointments. Let's get you set up with a third quarter appointment, and definitely year-end planning. I'd say that year-end planning, that appointment in October, November, and December is equally as important as your tax preparation appointment. Because once again, the tax prep appointment is just to review what we had planned to file in the first place, right? So the year-end planning appointment, it doesn't have to be long. It doesn't have to be arduous. It doesn't have to be, stressful. You just need to have a good idea of what your year-to-date income and expenses have mapped out to be. And, the power position that puts you in is that if you come in October and do some year-end planning, then you have November and December to literally go out and spend capital reinvesting back into infrastructure. And the government will allow you to pay less tax by going out and spending money on your own business, right? Like that to me is such a powerful tool to understand. I call it the tax discount. That's how I kind of explain it to clients. You put it perfectly, Bill, is that, if you're in the 41, 42, 43% effective tax bracket for both federal and California purposes, every dollar you're spending is saving you or returning you 41, 42, 43 cents on the dollar in tax savings. So I say to clients, hey, listen, you might be looking at the sticker price, but if you don't go out and make these purchases and you're just socking away savings for future whatever, and you're not spending it or reinvesting it back into your business, the government will happily accept the 41, 42, 43 cent tax dollar amount that you're going to pay them, right? They're not going to return it to you and say, hey, if we think you did planning incorrectly, here, we're going to give you another chance. That's not the way the government works. So that tax discount, to know what your effective tax rate is before the year end, that is an incredibly powerful shopping tool prior to December 31st.
What would you say the top 2 or 3 common mistakes in real estate are as it relates to taxes? Like ones that just come to the top of your mind.
Sure. We've been seeing a lot of new clients come over to our firm. I mean, probably over the past 20 years, we've just seen an influx of new clientele simply because the real estate professional tax code is probably, in my opinion, one of the most complicated parts of the tax code outside of the agricultural Schedule F farming forms. Those are pretty complicated as well. But the real estate professional part of the code has been around since 1962. And it really hasn't changed very much. But the proper way to make real estate professional elections, including non-passive or passive elections, which make real estate losses tax deductible or passive, meaning they're passing the losses forward into future years. The one largest mistake is people going out and making significant investments in real estate, not really fully understanding how it's going to impact their bottom line on their tax returns, or this is one that definitely comes to top of mind. People who have rental properties, they have heard on a YouTube channel or with a neighbor or a coworker, hey, you need this property protected under an LLC. So they'll go out and start an LLC, and the year will go by. They'll come in to do their tax returns, and they'll say, hey, Tony, you're going to be really proud of me. I set up this LLC for asset protection. And I say, well, great. What was the transfer what was the transfer date that you transferred the property title into the LLC? And they kind of look at me, like a deer in headlights. And I'm thinking, well, when did you actually transfer the title into the limited liability company for the asset protection? They say, well, we haven't done that yet. So that is one of the more common mistakes in rental property ownership, is that the cart before the horse, right? You don't want to incorporate yourself without consulting with an advisor, like an attorney or a tax advisor, because it is very much the domino effect that has to happen first. One domino has to fall before the other fall. Otherwise, you're just flushing money down the toilet. From a California filing perspective, from a tax preparation perspective, you're spending $2,000 to $3,000 a year minimum for preparation fees, and you haven't even achieved the greatest benefit of asset protection in that case. So the real estate professional part of the tax code, it's incredibly complicated, but that's really where Robert Hull and Associates, my team, shines, is because we know that part of the code inside and out.
How many pages in the tax code? It's always, every time we talk about it, I say, hey, where are we now today? Like, what's the number? We talked a little bit earlier. Share with everyone how many pages.
I knew that this was going to come up today, because a lot of people tend to ask me, hey, how complicated is the tax code? And it's around 75,000 pages long. That's the entire code. That's including foreign bank account reporting requirements. I mean, that includes everything. And the farming and ag side of the tax code is pretty deep. I mean, it's tens of thousands of pages long. The general code that we practice around is not the full 75,000. The general public tends to range in the 7,000 to 8,000 page range of just general tax code. But yeah, 75,000 pages.
Any new pages? Like every year they add some, take some. Where are we?
Sure. I mean, gosh, in 2012, when the Obamacare bill was passed, that was an extra 8,000 pages added to the code, if I'm not mistaken. That was a long time ago. I didn't check that number, but I believe it was around 8,000 pages. The 2018 tax reform bill under Trump's first administration was, I believe, around 3,500 to 4,000 pages. And then during the Inflation Reduction Act, they repealed several parts of the Trump first administration tax code. And so now in 2025, we're going to see a revamping or a repeal of a lot of the inflation reduction part of the tax code. So you're probably looking on average between, I'd say, 5,000 to 7,000 pages every year of revamped, amended code and additional code added to the tax code, which just blows my mind. I just don't understand. I've never understood in my 20-year career why the tax code has to be so complicated. I'm not complaining. I'm gainfully employed because of it. But I just don't understand how the government could think that the general public, one, has enough financial wealth to hire a licensed tax advisor who understands the code. But also, number two, if they're not hiring a financial advisor or a tax professional, how they're going to understand the tax code and implement those strategies in the appropriate ways and accurate ways. That's just always blown my mind over 20 years.
So before we get to the new administration, and I have a number of questions around that, when new code comes out, do you have a part of your team that scours through that both for opportunities and threats to your clients? And then do you get a general sense of how that would apply to someone like me, or maybe somebody that makes more than me or less than me, has more real estate, less real estate in California, outside of California? Do you guys go about it kind of more globally and macro and then get into the micro, the return, or what's the approach there?
So one of the greatest things, and one of the things that I really love about working for Robert Hall & Associates, is that since day one, we've been a think tank. When I started here, there were probably 16 employees. Now, 20 years later, we've got 56 employees here, and we only have one firm or one location, and we service all 50 states. So from a senior advisor perspective, we do, between personal education and licensed education, the actual education that gives us our hours of education to renew our licenses each year, we're around 800 to 1,000 hours of continued education on a year-to-year basis. We're not really expecting our tax associates or our junior accountants to go and do a deep dive into new tax code and teach us. It is very much a think tank. I tend to lean heavier on the real estate professional part of the tax code. My associate, Daniel Passon, leans more on the estate and trust and gifting side of the tax code. My brother, Michael Watson, who's acting CEO of the firm, he's kind of a general consensus guy where he learns just a lot about a lot of the tax code. So we're very much a think tank, and we then take that information that we learn and we teach it to our TAs and our junior accountants, or we share that information, and then they go through their own education as well. But it is quite an extensive process to educate yourself on the tax professional side of what we do. As far as being a bean counter, I don't even like that term, but somebody used it the other day, and I actually thought it was really funny because I haven't heard that term in a long time. We're not bean counters. We're not people who go through and nitpick the dollar for dollar amounts that come out of your bank account. That's what our bookkeepers do. When the tax advisor steps in, we look at the macro view and we look at the bottom lines and figure out creative strategies to help reduce that based on implementation of the code that we know and understand best. So yes, I mean, we do educate ourselves. I'd say anywhere between 800 to 1,000 hours a year in not only online in-person education, but also the EA journals that come in, the tax code that we read just on a daily basis. And then obviously we really lean a lot on our vendors, like Jeff Driscoll out of Pasadena with Lagerlof and Associates. Like he knows a part of the tax code that I sometimes need refreshers on because it's part of that 75,000 page code that I don't see every day. Yeah. Right. So these are things I really lean on our vendors because they are also part of our think tank, if that makes sense.
Yeah. So we talked about it a little earlier and some of the different real estate strategies. And I think most folks would be blown away at how many different tax opportunities exist in simply buying one investment property. And so you and I were talking about a case study where, the property was $800,000, and then they when they were going through the rehab, they used the Habitat for Humanity. What is it called for the charitable donation?
Called a deconstruction charitable contribution.
So, what that basically means is when you go in and rehab a property, a lot of that stuff they're taking out can be used in other projects like Habitat for Humanity. And there is part of the tax code that gives that investor credit for having those people come in and take that stuff apart in a way that they can reuse it and to account for it and to do an appraisal for it and then to issue a tax document that you, Tony, can use as part of the return. Yes?
Correct. Yes. It's an incredibly powerful tool. Mm-hmm.
And then those investors get in there and they beautify the property. You have the cost seg, which you're an expert in, which basically advances or accelerates depreciation on the property. Yes?
Mm-hmm. Yes.
And so in most of these cases, go ahead.
Do you want me to go into detail about just breaking down how that works really quick?
I would, please.
Yeah. Okay. So when I first started here doing Bob Hall's returns, I saw a lot of these strategies being implemented. But as I started to build my own column, I started off doing firefighter tax returns, police officer tax returns. And over the years, I've helped them build real estate wealth because I'm a big proponent of real estate investing from a tax sheltering perspective and a wealth building perspective. So, my clientele over the last 10 years, I'd say, has really kind of jumped to a different bracket. Both clients that started with me and they built wealth over the years, but then also the referrals that are coming in. I do executives at Apple, executives at SpaceX. I've got, pilots, and I've got big, contract physician firms. And it's the one thing that I always preach to them is the power of real estate. And so, as these people's income brackets continue to increase, they're always coming in saying, well, what can I do to help reduce this bottom line liability? And I say, okay, here, let me map out this plan for you just to whet your palate. And so I pull up their tax return, I make a copy of it in our tax software, and I plug in, let's say, a $2 million real estate investment. Something that if they did $500,000 to $1 million of work on might be a $4.5 to $5 million rental investment, right? But the purchase price, the entry level purchase price is $2 million. I say, well, let's say that we use ESA, Eco Salvage Harvesting, I think is the company that most of my clients will use, ESH. And let's say that out of that $2 million purchase, let's say that Eco Salvage Harvesting can pull out $600,000 of items, cabinets, lighting fixtures, electrical plugs, hardwood flooring even. And they pull that out because you're going to demo the home anyway. You're going to pull it all out. You're going to rehab it. So they pull it out. They give it a $600,000 value. All of a sudden, my client in a $2 million bracket or $1.5 to $2 million bracket now receives a 100% tax deduction for the $600,000 donated deconstruction amount, because one, you can write off up to 50% of your adjusted gross income in donations, like in-kind donations, and Eco Salvage Harvesting is giving them a $600,000 deduction for it. So boom, 600 grand, like you said, in the 41, 42, 43% bracket is going to save them $300,000 in tax, $280,000 in tax. Once they're done with the renovation of that home, they plan to turn around and rent it out. So all of a sudden, we've got this massive charitable deduction. And now that we're setting this up as a Schedule E rental investment, whether it be through an LLC or on the personal return, now we call it my good friend Jeffrey Gann at GTG Consulting. We throw a cost segregation analysis into the mix. And hopefully Trump brings back 100% bonus depreciation. As of now, it's only set at 40%. But then we can reach forward into future years with a cost segregation analysis and accelerate the building value of that rental property after the $500,000 to $1 million of improvements that you put into there. We can reach forward into future years, and through a cost seg election, we can accelerate that phantom deduction of depreciation, further reducing clients' taxable income and possibly putting them literally in a 0% bracket. I've seen it before. It's very difficult to do, but it's not impossible, is what I'm saying. Is it probable? Depending on what clients want to spend to have these kind of elections done, the preparation fees, all of that stuff. And I map all of the tax savings out and say, here's what it's going to cost you. Here's what it's going to save you. And it's like 300, 400, 500% return on investment in most cases. It's insane, the calculation. But like I said, we do that planning for people. And if they do it, the results are great. If they just feel like life has gotten ahead of them and they've got a lot going on, I understand that life gets busy sometimes. But if they don't implement the strategies that we put together for them, they're not going to achieve those bottom line results. But cost seg and the deconstruction loan, man, those are just two incredibly powerful tools to help people in high income brackets get into much lower income brackets, which I have seen, in a couple of cases that it does wipe everything out down to a zero balance due. And California it conforms to this, which California doesn't conform to a lot of parts of the federal code. California conforms to the deconstruction loan contribution amount and cost segregation, Section 481A of the Internal Revenue Code. So
yeah, and if you're at home doing the math, like on a $2 million property, you're putting 20% down. It's $400,000. In your example, if you had the $600,000 charitable donation at the tax bracket that you use, there's $300,000 in real cash savings off the $400,000 that you put down. So you're $100K in. That's not with the cost seg, and that cost seg on that property is probably going to be a few $100,000, $300,000 or $400,000 ish. I think, just in my fast math and recollection, you're actually cash flow positive on buying a new home that you've rehabbed in terms of your downstroke and your tax benefit. And now I'm guessing that they're either positive cash flow on their STR or long-term rental, or they're flipping it for a gain. It is kind of crazy.
It is pretty. I mean, the way that it maps out, yes, you are looking to achieve the max tax benefit to recoup that down payment. And I have had clients do this year after year after year after year. One client in particular had this idea. He went through kind of a tragic situation during the pandemic where he had actually lost a spouse, and he didn't have any kids, thank goodness, but he lost his spouse to cancer. And he said, I don't want to work I think he works for LADWP, if I'm not mistaken, and I don't want to work a W-2 wage job anymore. He had 3 rental properties in his portfolio, and he had just onboarded with Robert Hall & Associates. And we were able since 2020, since 2020, he has bought a new property every single year since 2020. We've done cost segregation. He's done one deconstruction charitable contribution amount because some of these properties didn't need that much in upgrade. But he has been able to purchase a new home and save his tax on his W-2 income because of some of the real estate losses. He doesn't have a property manager, so he actively participates in his portfolio management. And he is probably 2 to 3 years off from full-blown retirement in his early 50s from LADWP, which he thought was never going to be possible until we implemented this strategy, this tax strategy for him back in 2020, 2021. So what you think is impossible or improbable might be a different scenario if you talk to the right tax professional. I'll tell you that.
So without turning this into a political conversation, there is obviously a whole bunch of impacts when an administration change. And in this particular case, as we've watched the first 30 days and some of the incredible movement, whether you like it or you don't, in all these different areas of government spending, I think there's an awful lot of people kind of hanging on the edge of the couch to see what kind of changes we can expect from a tax perspective, both from a business and from a personal. So I'd like to just start, if you don't mind, with your perspective, the feedback you're hearing, stuff you're reading from a business standpoint. Let's start with that.
Yeah, so I just, if we could take a trip back in time to 2018 when Trump introduced the tax reform bill of 2018, I 100% believe that in 2018, when something called the QBI deduction was introduced, QBI stands for Qualified Business Income Deduction. That was something that was an incredibly powerful tool for a number of reasons. It allowed people to essentially make profit through their business and take 20% of their net positive cash flow as a Schedule C sole proprietor, as a partnership K1 owner, take 20% of that cash flow or that profit and pay nothing in federal income tax on it. Now, there are some limitations. If you're a specified service or trade business, there are some limitations. If you're an attorney or an architect, there's some limitations there. But I do truly believe that, historically speaking, that Republican tax reform has always been a very forward and progressive and positive step forward in the tax code for business owners. I think that most people would agree that Republican tax reform is always pro-business. I don't know if anybody's ever disagreed with me, even on both sides of the political fence. Back in 2018, that was introduced. Biden, when he was elected, he chose not to even touch that part of the tax code, which made me very happy. But now, fast forward to Trump's second term, I think he's in it. I think he's approaching things in a much different way very quickly. Things are changing very quickly by the day. At the moment, presently, we don't actually have a 2025 tax bill, but I do foresee, and I'm a betting man. I love me some Vegas nights at the blackjack table and the craps table. So, I am a betting man. So I would say 95+% chance, and I would put money on this, that bonus depreciation will be coming back in late April or early May of this year at 100%. Remember that part of the code, that benefit of the code, wasn't only meant for people who were buying heavyweight vehicles, right? It wasn't only meant for the G-Wagons and the Range Rover purchases. Sure, that was a benefit on that side of the tax spectrum. But where it really benefited people is through the cost seg election, where I could go out and buy a property, take 30, 40, 50, 60+% of a building's value and accelerate the value of the building as a phantom deduction. Remember, I'm not actually coming out of pocket for this deduction. The government is giving me the phantom expense on my return at 100% deductibility. Right now, currently, it's set at 40%. But Trump is pretty gung-ho, and I've read a couple articles, as of the start of this year, stating that the Republican platform does want to bring that back. In fact, it was already on the bill last year to bring back into play, and I think Trump is very much going to bring that back. So I do believe that we're in it to win it as far as business tax code is concerned. Mm-hmm. I'm very much looking forward to what we are going to bring back from 2018 tax reform bill, but then also what we are going to renew as far as QBI is concerned, bonus depreciation, so on and so forth.
So any retroactive thoughts, like he comes in, applies it for 25 and retros it to 24, or would it be really kind of a standstill moving forward?
Is it possible for him to make things retroactive to 2024? Absolutely. It is possible, because in 2018, when he passed the new tax bill, he actually made things retroactive to 2017, not completely back to January 1st, but to, I think it was, one was December 15th of 2017. Others were back to June of 2017. So it is possible. So I'm not saying no or yes. It is possible for him to make it retroactive to 2024. Is it probable? Probably not, because it's already end of February right now, and a lot of people have already filed their tax returns. And at the moment, they're letting go of a lot of IRS agents. So compliance-wise, to get a code in place that automatically amends people's tax returns without forcing accountants to go back and amend all the returns that we filed this year, it might be too much stress on the Internal Revenue Code's processing systems. I don't know how else to put it. It probably is not probable. Is it possible? Yes. Is it probable? Probably not.
And change in the tax code cannot come through executive order. That has to go through Congress, correct?
Correct.
All parts of it?
He can push forward a lot of things in change, but I do believe most changes have to be written into code, signed off by different legislative branches of the federal government before it is actually enacted as part of tax code. Now, as far as credits are concerned, I do believe President Trump can sign executive orders to force the IRS to give credits for certain things. I think that you're going to see a lot of this in 2025 because of the wildfires here in Los Angeles. I think that the government is very much going to back the state of California in giving what are called carryback loss credits for people who have lost literally everything. I have clients who have lost homes. They weren't insured. It is an incredibly devastating time in Los Angeles County. And so if the state of California gives pushback to certain things, or if the feds give pushback to certain things, there can be executive orders passed to force the Internal Revenue Code to allow these devastating situations a massive windfall benefit by carrying back what are called casualty losses for taxpayers who have lost everything, where they can carry that loss back to 2021, 22, 23, and offset liability in past years and get refunds from those years where the current tax bill didn't allow that. So there could be a lot of change in 2025. We don't have eyes on any of that now, but I foresee that is going to be something to look out for.
What about personal changes? We talked a little bit about business. What are you thinking about in relation to that?
Yeah, personal tax code changes. We're set to see the brackets obviously change. We already have eyes on that for 2025. Standard deduction has changed. It always changes based on inflation, where the economy's at. Child tax credits are set to change for 2025. QBI is set to stay at 20% of self-employed net profit. As far as what the government's focus is going to be on from a corporate standpoint, I do believe they're still going to be honing in on the 35 to 40% reasonable salary payout if you are structured as a corporate entity. They're probably going to be honing in on some of the larger tax shelters still. I do foresee the dialing back of audit rates. Just as a side note, by the way, I hope everybody understands this, that individual tax returns in general have less than a 0.38% chance for audit. Not 38%, not 3.8%, but 0.38% chance for audit. Partnerships, S-corps, have less than a 0.1% chance for audit. C corporations have less than a 2.9% chance for audit. So at the end of the day, when changes happen at the IRS level with code, both on the federal and the state side, your audit rate is still incredibly low. I mean, you have to be a big fish in a small pond in order to really have to be required to go through quarterly audits. You know, the Amazons, the eBays, the Starbucks of the world, they go through quarterly audits with the federal government from just a compliance standpoint. But the individual small business owner and small business under the IRS's eyes is anything under $10 million. But truly, from a case study perspective, it's really under $100 million that's a small business, and also companies that have under 100 shareholders. That tends to be the small business aspect that the government really doesn't focus on as much as they focus on the large IPO'd and publicly traded companies from an audit perspective. So, you know, the personal changes probably won't be too drastic in 2025. As the economy starts to rebuild itself under the Trump administration, I do foresee that 2026's tax code will see a lot more changes kind of compared year over year with 2025. We are going to see more changes in 2025, but we just don't have eyes on a lot of that yet.
So your point in bringing up the percentages and how low they are in terms of audit is really to say that even with all these reduction of enrolled agents, and I don't know what the last number was it 6,000 that they were reducing it by or something like that?
So their projected number is going to land around 15,000 agents, but I believe that they've already laid off 7,000.
So your point is like, hey, whatever those low percentages are, they're still low. It's not really going to move the needle. If you fall into one of those target areas or you're the lucky winner of the lottery and you're going to get audited, you probably were going to get audited anyways. Is that the thought process?
Sure. Yeah, and remember that on the individual side, to get somebody into an audit type scenario, not to get somebody into this scenario, but to be pulled for questioning, there has to be something off year over year. One of the algorithms that the IRS uses is when you're consistently making, let's say, $100,000, $200,000+ a year, let's say in taxable income, all of a sudden 1 year you drop below $25,000 of income, but you still have $20,000 to $25,000 a year in property taxes on a primary residence. You still got 10 to 15 grand in T-bill interest or stock account capital gain. They're going to wonder what happened, right? And so if you are just out there spending money to save tax, they want to verify your expenses, right? So that tends to be a little bit of an uptick in audit percentage, but still under 0.38% on the individual side. So there are algorithms, not AI just yet with the federal government, like I've been talking with a lot of my clients on, but there are algorithms that the IRS uses to see the year over year differences of income. And they don't just look at one number. I'll give you an example. I have a client who lives in Manhattan Beach who's got a $65,000 a year property tax bill. The home's been paid off for a long time, but they've added onto the property a lot over the years. And the wife used to be a very well-to-do realtor in the Manhattan Beach area. Now she's kind of heading into retirement. Well, the income is basically nothing now, right? But they have great brokerage accounts. They made a lot of money shorting Beyond Meat during the pandemic and other types of stock things. So they've made a lot of money, but that was reported in past years. Now, when you look at their tax return, they've got $65,000 in property taxes, but no income. Well, the government pulls their return for audit. It was a drop in the bucket. There was no change, but the government pulls their return for audit because they're wondering how this taxpayer can afford a house with $65,000 in property taxes, but no taxable income, right? Well, then all we have to do is show up and say, well, here's their brokerage accounts, here's their savings accounts, here's how much cash they have in a low interest bearing money market account. And even though they had a little bit of interest in dividends and whatnot, that's how they're able to afford living in this home in Manhattan Beach, one of the more expensive places in LA County to live. So it's all about proper representation at the end of the day. But the government does look at those unique scenarios, like how are people affording their lifestyle in LA County with all of this other stuff going on based on not reporting income.
Hey, Tone, I've never asked you this before, and it just occurred to me while we were talking, where I think one of the hits on Bitcoin or any kind of crypto is that the government can't keep their eyes on it. It is still a requirement, right? It is still a requirement of a U.S. taxpayer to identify and capture any gains and or losses in crypto trading and put that on their tax return, regardless of whether or not there are documents that come from that, correct?
Absolutely.
It's not a freebie.
In fact, it's not a freebie, and I don't know if anybody listening has heard of this story where a rehabber bought a home and started knocking down the kitchen walls and found $200,000 of Depression era cash in the walls of this home that they bought for pennies on the dollar, like literally $200,000 wrapped in saran wrap, hidden in the walls. And so they thought it was cool. So then they contacted the local news station and they made it public knowledge. And you know what? The government audited them and forced them to report the treasure that they found, because treasures are taxable under the federal code. Well, when you look at Bitcoin, I consider that to be somewhat of a treasure, because it's not a tangible asset. Like it's not something that you can hold, right? But it is something that is a growing value of assets. So the federal government steps in at the beginning of the crypto craze and they say, we're not going to treat cryptocurrency as a stock. We're going to treat cryptocurrency as an asset. So you have to file it based on the FIFO method, first in, first out method, and you have to use a software program that tracks your ins and outs of the coin. And the Coinly, Crypto Tracker. What's the other popular software used? There are a couple other popular software programs to use, and that you link it up to your Ledger or your Coinbase account or your Robinhood. Robinhood does a pretty good job documenting all of this, but it tracks your basis in these coins, and then you have to provide that Schedule D, which is the capital gain loss summary of sale and acquisition of asset. You have to report that on your tax return. So the federal government absolutely taxes you on the capital gain. And there is now a box on your return since, I think, 2020 or 2019 that we have to check as preparers, stating that you did own crypto assets, traded, received, so on and so forth, or that you did not receive or trade any crypto coins or crypto assets during the year. If we check no, and the federal government audits your return and they see crypto transactions, that's what puts people in a lot of trouble. Right, yes. Because they figure that you're evading taxes on an asset that is in and out and has basis and capital gain information attached to it. So yes, you're absolutely right. It is a requirement to report.
And I think there is a misnomer about what is criminal and what is more frowned upon and would require corrective action. Not declaring income is tax evasion. That is criminal. Writing off something that the government through audit determines maybe you took too much or you shouldn't have taken it at all or it was categorized the wrong way would get a corrective action and or tax and penalty, but it's not criminal. Is that correct?
Correct. Now, if you are under audit and they disallow a large deduction and it significantly increases your bottom line liability, unless it's a special case where it's an investment being audited, or if it's some other thing like a Ponzi scheme that people invested in and they disallow the deduction, at that point, that significant change in bottom line liability because of the disallowance of the deduction, that could hit a taxpayer with what's called a significant understatement of tax liability penalty, which is on top of the ordinary estimated penalties, interest, late payment penalties, underpayment penalties, so on and so forth. But yeah, it's not illegal. It's the one thing that really gets people in a lot of trouble and potentially sees, this person would potentially see jail time, is the underreporting and significant underreporting of income. But I can tell you right now that the government, if that person was to be sued in tax court by the federal government, there would have to be proven intent to evade tax liability, right? Yeah. So this is not the 1950s, 1960s anymore, where the government had all that power in the world. And yes, they do have way too much power, and I'm excited to see some of the agents leaving the agency over the next couple of years, so that they do have less power and less oversight. And that's just because they grew too powerful too quickly. But in the 1950s, 1960s, the IRS could literally show up to somebody's place of business, deadbolt their doors, and shut them out of their business, and then they go bankrupt, right? Now, fast forward to 2024, 2025, for years we've had the taxpayer's advocate, which is a branch of the government that actually fights the Internal Revenue Service on behalf of the U.S. taxpayer. So if you are ever treated unfairly or unjust by the federal government, your tax advisor reaches out to the taxpayer's advocate and writes letters to state congressmen stating that, hey, because of this, this, and this, X, Y, and Z under the Internal Revenue Code, we believe that our position or our interpretation of the code stands. We are being treated unfairly by the federal agency. Please help us out. And the taxpayer's advocate, 99.9% of the time, wins the argument, because they are very much a branch of the government that knows probably more tax code than most IRS agents do.
Wow.
And so I feel very comfortable and powerful in my position nowadays. I feel empowered because if push came to shove, I do have a branch of the government that fights for the taxpayer. And that's been around since, I think, the early 90s, if I'm not mistaken, is the taxpayer's advocate. So I don't know if a lot of listeners know that about
probably not.
About the
no, that's kind of cool. So, you know what else is I think a lot of people don't know is that you can sign up with the IRS so that you get transcripts before you file your return. And if you have a lot of different things going in and out, it could be easy to miss a 1099, 1098, or W-2 of some sort. And by signing up, and by being part of that process, you can literally print out all of the documents that the IRS has received on behalf of you for that tax year and use that as a baseline to make sure you never underreport income that has been received. Correct, Tone?
Correct. It's an incredibly powerful tool. I have clients who have, 15 different syndicated investments. I've got clients who get, 10 or 15 1099s from brokerage accounts. I've got clients who go to Vegas and have I had a client the other day, 52 W2Gs from the casinos, right?
Wow, we got to hang out with that guy.
Yeah, I know, right? I know. She's a doctor, and so she goes and sits at those slot machines, throughout the year. So she had 52 W-2Gs, and I kept asking her, I'm like, are you sure you've received everything? And sure enough, she went to the 3 or 4 casinos that she gambles at, and she gets the win and loss consolidation statements, and it all added up. But I always like to tell clients, hey, listen, let's prep your return. If you want to do it during tax season, that's fine. But in June, so in the summertime, once the IRS's computer systems have fully updated with all of these submissions of 1099s, W-2s, K-1s, so on and so forth, let's go ahead and ping the IRS requesting wage and income transcripts and account transcripts. And that way, when we actually file, it's not guessing if we have all of the documentation that was filed under your social security number. We cross-reference it with the IRS transcripts, and we report exactly what the IRS shows in their computer system. It is an incredibly powerful tool, especially for those of you who have multiple brokerage accounts. I've got me personally, I've got 8 or 9 brokerage accounts, right? So, and I know where they all are, but let's say that my house burned down. Let's say that I lost my laptop and I don't remember what my passwords were. And all of a sudden I'm on a permanent extension through October 15th because of the fires. I'm going to wait until June, request wage and income transcripts, and just go back and cross-reference with everything that's been filed under my social security number, just to make sure I have everything, right? Because a lot of people in LA County have lost everything, right? I have clients saying, well, I lost all of my books. I lost all of my receipts. I don't know what my passcodes are. So I tell them, listen, this is an incredibly powerful tool. We can't get the full transcript until mid-June, but they're on permanent extension anyway through October 15th. So let's just push it off and get those transcripts.
Pause there for a second. You just said they're on permanent, the push from April 15th to October 15th. Who does that apply to?
All of Los Angeles County residents, because of the uniqueness at the start of 2025 with I think we're between 13 and 15,000 homes between the Palisades and Altadena fire, the Eaton fire. Every day, every 2 or 3 calls, we're getting calls from clients who have literally lost everything. I was watching the news the other day. One of my clients is being interviewed on CNN because he lost his home. This is so widespread amongst a very large city. But what it's made me feel this year is that even though LA is a large city, it truly is. It feels like a smaller city than it actually is. I mean, it's no longer 6 degrees of separation. It's more like 2 degrees of separation. Everyone knows someone who lost a home, or a kid was displaced from school, or a church or a temple burned down, or a business, brick and mortar, burned down. So the federal government stepped in, and the state of California agreed with the feds. They said in the entire county of Los Angeles now no longer has an April 15th deadline. Their filing deadlines and their payment deadlines for liability and retirement funding deadlines have all been pushed out to October 15th.
Whether you were affected or not, you live in that county, that's
Correct.
something. I mean,
Correct.
That's a real thing.
Oh, absolutely. The only thing that is that is zip code specific is the deferral or the delay of property tax payments. The county assessor only allows, I think it's like 12 or 13 zip codes to delay their filing. And people have asked me, they say, well, why, Tony? If my house is still standing, why, even though I'm in LA County, why don't I not have to file until October? Well, I can tell you right now that after the fires had kind of ravished the areas in the Palisades and Altadena, alone on my street in Los Angeles, we saw the number of cars parked on our street go from 3 or 4 cars to literally the entire street parked and lined with cars, because people were calling their friends. People were calling their family members, and they are living with their family members and their friends now. Their children are now being placed in schools on top of already maxed out classrooms. My son's classroom just added 10 new students in that classroom. Everybody has been impacted in one way or another. Our seasonal revenue here at Robert Hall & Associates, my January, February, March, and April are usually my highest revenue earning months, right? We generate a lot of our revenue here at the firm in the first quarter of the year. Well, with all of the LA County clients going on extension and not filing, our revenue in Q1 has been a lot lower than most years. So it goes so much further beyond somebody losing their home. I'm not complaining about the revenue. I'm here to assist with all of the fire victims. But the government saw that from a macro view, and they said, you know what, we're just going to put all of LA County on extension. That way, if they were impacted without having to explain it to the governing agencies, we're just going to give them a permanent extension through October 15th.
It's amazing.
Yeah,
it was the right thing to do. Hey, Tony, as we wrap up, I was driving in this morning and I was thinking about how AI is taking such a large position in lending in terms of, how we think about underwriting, valuation, title, entity reviews, and the like. I mean, it plays in so many different parts. And it just occurred to me that could this work its way in a manner that either you, after preparing a return with all of your expertise and experience and personal connection to that particular taxpayer, and the artificial intelligence that has learned the 74,000 pages of tax code or the like, would then call out either some areas of concern or opportunity. And as you think about that answer, could it also be used from the agency side to flag outliers in the way that you said their algorithm does, but obviously more sophisticated? I don't know if you've even thought about that.
Every day. I mean, as an investor myself in NVIDIA, in SoundHound AI, one of my larger positions is Apple. I am trying to learn as much as possible about the AI industries and also investing in AI, because I truly feel like these types of financial positions in AI-backed type corporations, this is generational wealth building. We are at the forefront of a tech change that is not a bubble. I mean, this will literally alter the way of doing business. I mean, Wendy's, for instance, the fast food chain, has already started implementing AI in their intake microphones. Like when you pull up through the drive-through, it's no longer I think it's like 20% of their locations. The voice that you hear when you are ordering is not a human voice. It is AI taking your order, and then you get the human once you get to the window. So we're already seeing it implemented in other spaces, in other industries. Here in the tax world, field, we started beta testing a software called Corvi. And Corvi uses a little bit of AI, but not 100% AI just yet. And it is a tax planning software that we like to check our advice with, right? It's just making sure that, when we're working the 18 hours a day during tax season, that we are still mapping out the full and thorough plan for our clients. And so we've been beta testing this software program. And sure enough, we're still ahead of the curve, because I don't think AI is just there yet on the tax preparation side of things. But Corvi is part of our tax service managing program that we're trying to build here at Robert Hall. And it's not quite there yet, but Corvi will essentially allow you to plug in your W-2 income, projected revenue for 2025 or 2026, how many dependents you have, what age you want to be able to retire at, and if you plug in the 50 or 60 pages of information accurately, it will create a full-blown analysis for you and your business that is not spot on with our advice, because I do truly feel like there's still the empathetic side of advice. There's still the human aspect of advisory and the interpretation of the code that's not fully there in AI software, but it's getting there. On the tax preparation side, it still has a long way to go. On the audit side with the federal government and the compliance side, processing of returns, I think we're a long ways off from it personally. I could be wrong about this, but once the federal government starts implementing AI, I think it's going to be very similar to what they're doing right now. It'll be an algorithm to flag certain returns, but it won't automatically pull a return for audit, and it won't proceed forward with the audit with an AI generated personality. It will still get kicked out to a human, because there is still a human aspect in auditing somebody's financial world, right? Somebody's revenue, somebody's expenses. They need that human explanation. AI might take the notes on the file on behalf of the agent, but at the end of the day, a human being will have to make the deciding factor of that. We're not quite at the Terminator stage like Skynet. We're not quite there. Could that be down the road? Absolutely. But I think we're still a long ways off from that. And I really hope it doesn't ever come to that. I think there's a lot of good behind implementing AI, but it is also very scary. I'm not really scared of using AI in my industry, because at the end of the day, once again, we have the taxpayer's advocate. We have representatives here at Robert Hall. Our clients never talk to the IRS. They hire us. They submit over a tax power of attorney to us as enrolled agents and representatives in front of the IRS. And we do the representation side with the IRS. We converse with the IRS agents. Our clients don't ever talk to them, because the IRS is going to walk all over our clients, knowing that they know nothing about the tax code, whereas they can't walk all over us. We know more about the code than the agents do. Yep. So that's the approach. But AI is definitely here, and it's not going anywhere anytime soon.
As we wrap up, anything keep you up at night right now, other than 18-hour days?
Yeah, other than the viruses my kids bring home from school every other day.
Amazing.
My industry is very unique, and I'm not going to say that it's any more unique than any other industry, respectfully speaking, about the lending world or the wealth management world. But what tends to keep me up at night is, am I doing enough on my end for my family, and am I making the right choices, and how can I implement that strategy to my clients? I'm very open with my clients. I tell them, hey, listen, I would never do anything on your return I wouldn't do on my own return. And I think that gives people peace of mind that it's not just the Wild West when they come to see Robert Hall & Associates, right? It's not like I'm just going to do everything I can to get them the most money back. I wish it was that easy. I wish that it was something that I could do without repercussion, right? But at the end of the day, I'm not going to take a position on a return that I wouldn't take on my own return, right? So the things that keep me up at night, It's very few things, because I tend to be very exhausted at the end of my workday and I fall asleep very quickly. But it's am I planning the right way for my clients? Like that truly is something I think about. I go home and I dream, especially during tax season. I dream about my files the next day, talking with my client. It's just, I don't dream about that all year round, but during tax season, it's just because it's at the forefront of my mind. And that sometimes keeps me up at night, is just knowing I got this big file tomorrow. Have I prepared enough for it? Did my team get all of the documents? Is this going to have missing information? Is it going to put me behind in tomorrow's schedule? Is it going to force the client to be put on extension because we're waiting on things that won't come in before April 15th? So just the normal things over a 20-year career that you worry about. But make no mistake, it is an exciting industry, and it has taught me a lot about a lot. I get to see so many professionals in so many industries across the board where they're making money. I talked to one of my Apple executives the other day, and it's not insider trading because they didn't give me any insider trading, but I asked about the AI side of how Apple is approaching AI. And I've talked to executives at Dell as well, and these companies are incredibly heavy on the AI space, and that is where I am positioning myself. Companies that are focused on AI, companies that are putting 10, 15, 20% of their overhead into AI development. So those are things that I'm excited about in my industry. I'm excited to talk to my clients, my high net worth clients, to strategize with them, to save them money. And once again, you might approach our conversations as, okay, how is Tony going to save me tax, right? But I approach it as, how am I going to help my client retain this wealth? I look at the W-2. Oh, it's got $5.5 million W-2. What can I do to help them retain that money and not overspend with Uncle Sam and basically flush it down the Internal Revenue Service and Franchise Tax Board drains? That is my worry day in and day out. How am I going to strategize?
I know that to be true, Tony, and I personally believe you are best in class, and I think those folks that get to hear you either on this podcast or the many conferences that you speak at feel the same way. If anyone needs to get a hold of you, how would they do that?
Absolutely. Best way, if you're a new client, if you're a current client and you already are with us and you have our contact information, but if you're a new client, the onboarding process is pretty straightforward. You go to roberthalltaxes.com. You click on the new consultation tab. It has you fill out your contact information, and we'll reach out to you to get you scheduled with an appointment. If you want to shoot me an email, Tony Watson, TonyWatson at roberthalltaxes.com, Tony Watson at roberthalltaxes.com. Once I get that email, I'll forward it over to Boyan, who's our new client intake specialist. He'll give you a call. We'll get you set up with the time to speak. We do offer free 30-minute in-person or over-the-phone consultations. And we still got openings before the end of tax season, obviously, because a lot of our LA clients are on extension this year. So reach out, and we're readily available to assist with any questions or needs that you have.
Everyone, whether you're happy with your tax preparer or not, should take advantage of that 30 minutes. I consider you a friend, a partner, certainly a value add in my family, and am super grateful that you took the time to share your unconventional story with all of the folks that are tuning in. Thank you very much. Appreciate you, and God bless you.
Thank you for having me.
That's a wrap. Make sure to follow us on social media at CV3 Financial and join the Unconventional crew for more inspiring stories and insights. Go be unconventional.